If you're looking to achieve financial freedom, reducing your debt-to-income ratio is a critical step. In this video, we'll cover what debt-to-income ratio is and why it matters, how to calculate it, tips for reducing it, and how to manage your debt and increase your income. Your debt-to-income ratio is the percentage of your monthly income that goes towards paying off debt. A high debt-to-income ratio can impact your ability to get approved for loans or credit, as well as limit your ability to save for the future. To calculate your debt-to-income ratio, add up all your monthly debt payments, including rent or mortgage, car payments, credit card payments, and any other loans. Divide that by your monthly income, and multiply by 100 to get the percentage. To reduce your debt-to-income ratio, start by creating a budget and cutting back on unnecessary expenses. Consider consolidating your debt or negotiating with creditors for lower interest rates or payment plans. Increasing your income is another way to reduce your debt-to-income ratio. Consider taking on a side hustle or seeking a higher-paying job. Working with a financial advisor can also help you manage your debt and increase your income. They can help you create a plan to pay off your debt, build your savings, and achieve your financial goals. By reducing your debt-to-income ratio, you can achieve financial freedom and pave the way for a brighter financial future. Thanks for watching, and good luck on your journey to financial freedom. Please subscribe to FinWizard YouTube channel for more personal finance videos.